Good morning and welcome to the second day of this Investor Conference 2022. We're very happy that you're here in this important conference for Credicorp Capital. We are starting the panel called New Challenges or Opportunity of the Capital Market. We're very happy to have you here. We have a very interesting panel with the situation, and now I'm going to introduce my colleagues. I am Fernando Ostornol. Good morning and welcome you all to our investor conference held by Credicorp Capital. We are very happy to have you here this morning. A very interesting panel named New Opportunities of the Capital Market. We believe it's a very interesting event, and we have a panel of experts and colleagues with whom I work every day, experts in their disciplines who will be discussing and analyzing very important matters for the capital market, which is so important for a region. Let me introduce myself. I'm Fernando Ostornol, Managing Director of Corporate Finance. I joined Credicorp Capital 4 years ago. I interact in a regional area, colleagues in Peru, Colombia, Chile, where I am now working. So I have a general overview, and I'm very glad to moderate this interesting panel today. I have María Salazar from the corporate finance area. She's a senior associate at Credicorp Capital. Also, Francisco Ghisolfo, executive director of asset management, specifically focusing on the real estate area, and Carlos Blanco, also managing director of the capital asset management, also leading our regional private debt effort. So I'm going to take a couple of minutes to introduce my colleagues that will be here at the panel. Let me start with Ana Maria. She's been with us for 5 years. She joined as an analyst, and now she's a senior associate. She's a professional with broad experience in bonds issuance. She had to participate in structure and also help in the placement of over $1.3 billion, apart from being the ambassador of GI Gender Credicorp Capital. Recently placing the hat of a very specific and relevant area of strategy for Credicorp in general, which is ESG. She will be joining us in the first presentation. Then we have Francisco Gizolfo. He's a civil industrial engineer from the Pontifical Catholic University, Chilean, working in Santiago. He's been leading the real estate business in the last few years in Credicorp Capital, where he has grown a lot. Here we see that he has structured funds with assets for more than $400 billion, and currently he's expanding the business outside the border of the Andean region. And last, Carlos Blanco, as I said, MD of the asset management. He has a Bachelor in Business Administration from Universidad del Pacífico, also an MBA from the Tax School of Business of Dartmouth University, United States. He has more than 30 years experience managing credit operations, both in banks in Peru, Bank Beef, WISE, and also in Bank Boston and IFB in the United States. Has extensive experience in credit origination and structuring, as well as the risk management. Apart from originating and also leading private debt, He's been general director of the indebtedness and public treasury in the Ministry of Economy and Finance of Peru. This is both public and private debt, and so it's interesting to listen to what he has to say. To give you some context, I would like to take a couple of minutes, and I think it's really worth it, taking the name of this panel and the challenges that we have, and under my responsibility in capital market, I want to talk to you about what we're seeing in the region, what we observe in the classical public debt and equities with a reduction in liquidity as a result of several things. And I would say that this started in 2019, 2020, where we had some social movements and political movements that were quite relevant in our region, but also a unique event, quite extreme, such as the COVID pandemic. What happened? Governments had to react with extreme measures in view of a situation that was unique in history by injecting broad amounts of liquidity. Our economies had to do that. And also that caused different measures as the withdrawal of the pension funds in Chile and Peru, where we see reductions in the case of Chile of around 11% in the last couple of years, and in Peru of 36%. So our capital markets have squeezed as a result of that on the liquidity of our capital markets. Colombia is experiencing a different reality. The measures are impacting the bank, and so banks had to increase a lot their interest rates to have catchment, and also increase in interest that. So the scenario is of lower liquidity on the one hand as a result of certain structural changes, higher inflation with interest rates that were not seen in the region, and important political and social changes that also add volatility in our capital markets in the Andean region as a result of certain uncertainty, especially in the taxation and pension area. So what happened? The traditional debt for our customers and businesses has become more challenging in order to structure an issue, and we had to become creative at Credicorp Capital. That's why we created and designed this panel, and I think it's quite proper for this situation. So to summarize, we see smaller capital markets in our region, lowered liquidity as a result of institutional investors that stop and wait and observe. And so in order to help our customers, we move capital and have access to capital, and we were forced to look at different things. That's why we have 3 topics here that are essential, we believe, for the development and the operation of the capital markets for the following years. One is the ESG subject that becomes even more relevant, not only in our region. This is a global subject that does not only impact our financial industry, but many others in the world. But if we look, and in fact, we had advisory from a very prestigious worldwide consultant firm that told us that the point 1 and 2 in terms of strategy in the world is the ESG. So this has come here to stay. We are capitalizing and we're helping our customers understand how we can use the capital markets vis-a-vis these topics. Then the second, alternative assets, we'll have Francisco explaining the opportunities in the real estate world, but outside of our world. And finally, Carlos talking about a private debt as a complement to this lower liquidity in the traditional debt of the capital market. So with no further ado, I'll now give the floor to Ana Maria, who will begin with the ESG presentation. So I hope you'll like it and pay attention to the last part where we will have Q&A session in order to clarify some things. Hello, good morning to everyone. Thank you so much for the introduction. So we're going to talk a little bit about everything that has to do with the theme bonds that have been quite a fad in the last few years, even though They've been around for a long time in Latin America, but they've been lagging a little bit behind. But first, let's talk about what these theme bonds are, the main labels we have, things that should be done, and what are the eligible projects that could be quite successful or beneficial for you in potential investments or capturing investors or issuers or people from the retail industry that might acquire this sort of bonds. So first of all, these are fixed income instruments whose resources are used in order to have an impact in a sustainable way in everything that has to do with sustainable development. Within the main tags that we see here or labels are the green bonds. Green bonds have a long track record. The first one was issued in 2007, so it's one of the best known. In order to qualify this, we have to finance or refinance projects that are looking to have a positive impact on the environment, especially in terms of climate change and also reducing the carbon footprint. This is very important because one of the last things that the World Bank said, an average citizen in the world issues 4 tons of carbon dioxide. And so the idea is that towards 2050, this is below 2 tons each. So our countries, both Peru, Colombia, and Chile, have lower demands. We are talking about Chile around 4.6, a little bit higher than the world average, but Peru and Colombia are close to 1.5 tons. So that is all the investment that you need to do. Imagine the investment you need to do in order to reduce this carbon footprint worldwide. Among the eligible green bonds projects, there is a broad choice of options: renewable energies, energetic efficiency, clean transportation, green buildings, wastewater management, all of that focus on the adaptation of climate change. The next one, the next known label are social bonds. And after the pandemic, after COVID-19, there has been a stronger boost due to having a positive impact or maybe recovering all of the social aspect. And here, the main point is to have an impact on various communities that have been vulnerated or weakened, for example, the reduction of the poverty level or ensuring everything that has to do with health, education, and food security, access to various essential or basic services, and also accessibility to financial services. Those have been the ones that were mostly issued in financial institutions, really paid a lot of attention on the issuance of the financial sector. We from Credicorp Capital this year through banks, we had a label bond, which is a social bond, gender equality. The other label is kind of a combination of the previous two. These are the sustainable bonds. So here we finance or refinance projects that have an impact both on the environment as well as on different communities. So here you can have a combination. It may be a project with an impact on society and the environment, or you might have various projects, green projects, and additionally also social projects. All of these labels are regulated by international associations, mainly the LECMA, that's the International Association of Capital Market, that has provided various guidelines of principles for green bonds, social bonds, and sustainable bonds. And we also have CBI that has provided guidelines for the labeling of green bonds. There is another label that is very recent. These are those bonds that are related to sustainability, and we'll talk about that later on in more detail. These bonds are associated not to a project per se, but the issuer globally needs to comply with certain KPIs that will cause a reduction of certain metrics that have a positive impact on the environment and also on the social aspect. So why do we talk about these thematic bonds? Recently, in 2015, there has been a huge boost. And when the UN got together in 2015, the Sustainable Development Goals were defined. They need to be complied with by 2030, and they comprise various themes, 17 SDGs we have there. And in the last few years, all of these thematic bonds have had an impact on various situations affecting the world, especially the end of poverty, zero hunger, affordable and non-polluting energy, everything that has to do with climate, and so also reduction of inequality. So all of these bonds, with all of these bonds, you can identify which of the SDGs you are impacting the most in each of the projects. So this makes a fundamental difference in being able to have a positive impact on all of this debt that we have with our planet and with society due to the whole footprint that we've left.
One of the important things, and we've observed this, is the issue of greenwashing. So at the end of the day, these bonds, even though labeled, may not have the intended impact. That is why it's important, if you are issuers or investors, you need to check carefully the difference between a normal bond and a thematic bond. And here we need to follow the ICMA standards, which are specific to thematic bonds. And you need to be very clear on the use of the funds. So this is a cornerstone. This is very specific to understand where resources are going. It's not that the company can spend it on whatever it wants. These bonds are specific to the green bonds and the actions that will have a sustainable impact. Second, there is a strict selection process, and this should also be very clear on the framework of reference. And this is reviewed by an expert that makes us feel certain that this was carefully checked and is in line with the international principles. And also the resources. As long as there is not an adequate identification of the right project, these things cannot be spent. And also the reporting issue. The necessary allocations are being given and the impact that is being made on the various environmental indicators and social indicators of the impact of these resources in sustainable finances. Another topic that we've been asked about is the issue of second party opinion leaders. This is not very much defined. Some people say yes, others say no. And the offer of the labelers is broadened. J, Equa, and in the past years, the big four and the main companies have also opened their sustainable finance areas. This is an opinion that certifies me, that shows that it is the bond being issued that complies with the ICMA and CBI standards and that has all the qualities necessary to choose the projects that has an adequate process, and this certifies the bond issuer that it is in line with the principles. In addition, something that has been very important for the industry, regulatory for the capital markets of each country that have been issuing their own checklist as to what applies for a labeled bond. And that helps a lot because not anyone can place a labeled bond, but they should be in line with international and national parameters. And another thing that helps a lot with greenwashing are the penalties. If you do not comply with indicators, for instance, and the KPIs, and you don't fulfill certain KPIs, you could be penalized. Even though in our countries, this may be a little bit far away, this has been a boom globally. The first green bond was in 2007, and then there has been a low curve. However, in the past 3 years, the boom was very steep. In 2019, we were $3 billion. And in 2021, we got to the $1 trillion in labeled bonds. So the green was the main, 50%. And we've seen how we've been able to see the social label, and the sustainable bond remained, and now the bonds related to sustainability for the past 2 years, we've seen a strong boom in labeled bonds. As for who is issuing these bonds, these supranational entities, for example, the European Union is one of the entities that has issued the most. Also, financial institutions that are very prone to this type of issuances because they can effectively allocate them among the various users that need resources. And then in terms of the volume, as I said, green, more than 55%, social, 31%, sustainable. And we see that the bonds related to sustainability are gaining importance. In terms of the sectors, this is diverse. It was all very much focused on the energy sector and renewable energies. But in this pie, we see a diversification. As you can see, in 2021, we have green, clean transport, housing, finances, financial inclusion that was also very much used lately. And moving on to LATAM, of that trillion that we saw on the previous chart, we have actually little participation in LATAM. 2020, 2021, 4.5% of the global issuance. But in 2019, we've seen that governments, our governments, particularly in the region where we have presence, for instance, in Chile, social bonds, Peru with sustainable bonds, Colombia with green bonds, have been also promoting this type of markets. And here, the distribution versus the global level changes. So here we are seeing more social bonds, bonds more related to sustainability than green bonds. So that is a difference we have versus the world. And in relation to industries, well, this was very much driven by government entities, the states, and then the corporate level, a strong issuance, particularly from banks, because banks are the ones that have issued thematic bonds mostly. So 13% green, social bonds 31%, and sustainable bonds 23%. And those related to sustainability 32%. In relation to sectors, well, we are more focused on energies and clean, the clean transport and constructions. So these are the thematic bonds that have been very popular, and from Credicorp Capital, we are strongly convinced that even though there is not an important price differential between the normal bonds versus labeled and non-labeled, we believe that the government is heading towards and should head towards labeled bonds. And during the pandemic, there has been also this direction that ESG investments must be made. Maybe in some local markets, this is not so strong, but at international level, we see this trend. And we see many investors looking for bonds in the region in line with the criteria, certified bonds, in order to, again, allocate resources to the sustainable goals and actions that improve our quality of life and protect the planet. So, Fernando, I can make a pause here. Thank you, Ana Maria. Very interesting presentation. And this would be a topic for one whole panel. Of course, we are giving investors a good view about what is going on in this sector. And at Credicorp Capital, every time we can, we discuss this with our clients. And in the Andean region in particular, there are many industries where our clients operate are improving access for transport or are on their way to change their energy matrix. And of course, non-conventional energies are taking the lead. So this offers huge space for improvement. And in the capital market, this may be more limited, but we cannot ignore these amazing opportunities, which are strategic. And we clearly hope that these opportunities will also be beneficial for our investors. To say the thematic bonds are important, the principles of the UN are important, and transactions can be realized with an interest rate linked to certain KPIs so that we can promote investments here. And finally, our corporate clients can pay a lower financial cost for the benefit of these variables. Thank you, Ana Maria. And now we are going to dig deeper into other topics. Later on, we can open the discussion, right? There was a question here about an investor. How can we put all this into practice? So let's move on to Francisco's presentation. Francisco has vast experience in real estate. He has expertise in these products. And as I said, he's leading the creation of new products, trying to diversify the market in this sector. So Francisco, please describe the situation of these real estate funds in the US and how we can access them. Thank you. Thank you, Fernando, for your presentation. I see that, well, you can see the presentation on the screen. Thank you very much to our clients from Peru, from Chile. You are connected from early. Let me share with you the situation in our markets where Credicorp Capital participates and the real estate funds in the US. As Fernando said, we have vast experience in the management of real estate assets, and we are taking the first steps in the US in this market. So you can see the first slide. Let me see if I can make it as entertaining as possible. But let's take a look at some data. Maybe this is not new. This is data from Chile, where you can see the Association of Investment Funds data and how there is an upward trend at the end of 2014 to 2021. The investment of managed funds, investment funds, those funds offshore are seeing an upward trend, and this trend has grown just as we see with the green funds. And we see that the main destination is the American market. Here we show the funds that invest and the investment funds that feeders that feed other AUMs that are in foreign markets. When we see direct investments here, around $600 million of AUMs, and the profit here, we can see that we have 8% private debt, and the opportunities and offshore offers opportunities. And then there's another incipient development. Here at the bottom, we can see in Chile, 30 vehicles making direct investments in the US. And as I said, this is not new, but in the first quarter of 2022, we have this list of managers that have funds abroad, particularly in the US. So we see the international aspect here, 30% of market share. And this international independence or Independence Internacional, well, as Fernando explained before, we have also presence in Colombia, Peru, and Chile with different strategies, with the same sectors, but there was nothing in the Northern Hemisphere. So we made this alliance with Independencia, which is the leading manager in the United States, operating for over 16 years. And we launched our first vehicle, which is Credicorp Capital Independencia Real Estate US1. So this vehicle is the partnership between these two companies and is going to co-invest with other funds. We are going to make a project pool, 5, 10 projects, depending on the amount we can collect. And this vehicle is going to have the following structure that I'm going to show, but it will represent all the flows, the business flows in the US. So co-investment is managed by the Credicorp Capital real estate unit. So we are planning to collect up to $100 million. We are going to offer this to our private banking clients and to our institutional clients. We are going to give them access to co-invest with Independencia. In Chile, we are going to have a Chilean vehicle, but also an offshore vehicle to invest directly in the US. So we see terms for private equity. We don't like those eternal funds in the secondary market. We have a fund executed by business plan, and then the asset is sold. And for that, we need 6 years, because if the market is not so good, then it's important to have a local market as an option. And these will form a portfolio of diversified funds with a value ranging from $500 million to $1 million. So this fund is going to invest where we have experience. There will be opportunities in the multifamily sector, retailing sector. These are the most attractive today. Of course, there are always some risks. I said retail, but I correct myself. Multifamily, industrial, and offices. And the investment strategy is going to focus on the plus assets, not the core assets. I'm going to show you more in a minute, with 66%. And a fund like this is an income fund, not a development fund. So around 10, 12% annually. So this is what we are seeing today. Let me go to the next slide.
So how does this partnership operate? We tried to explain this in this slide, where you have 3 spheres. Here we have Independencia in dark color, the social partner, that could be explained later on. And finally, Credicorp Capital. So let's start with Independencia. I would like you to understand why Credicorp was looking at the American market. We've been doing so for 2 years, and we started with Independencia due to this, due to the fact that they do have the experience, they've been doing well, but they've also had bad cases, and that is really very important for the real estate world. It's just like riding a bike or skiing. If you have never fallen, it's because you've never done it enough. Independencia has done this, and all of that gives us experience and know-how in order to better manage future investments. It has a team in the US and Chile. Of course, we're more interested in the American one, and Miami, Boston, and Denver. They have great capacity of origination, and something really important, they have the track record of sold units. I said that this fund will buy and sell assets. They already have more than 38 properties that have been sold with an average tier or 13%. They will give an agreement. They will be presenting everything that they analyze so that the team, and now I'm talking about Credicorp Capital, can make a selection. And then we will see that the kind of assets are the same. They will show all of the metrics to our customers, and then we'll have a second layer of analysis in order to see whether the opportunity introduced by Independencia is eligible for our joint funds. And we move forward with that. That will be the main role of Credicorp Capital. And we also have some decisions where we might detect conflicts of interest. And none of this would be possible without the local partner, the general partner, as they call it in the US, the GP. Each of the assets will have a GP. This has to commit equities. That is really very important when you do this sort of business with the GP. For you to understand, is the promoter, the real estate promoter or sponsor, the one that manages and has the technical team, the one that does property management, etc. They need to have skill in game. They need to have equity, and we are demanding 10% of the equity, and they give us all of the local experience. And that's where Independent also gives that they've been working with these GPs for many years. It wouldn't be their first adventure, but on the other way around, they already know who to call in case they want to buy a multifamily in Florida, or which is a very different option, or a multifamily in Denver. So this local partner gives us all of this. They generate businesses, and they are also key partners in this fund that with these three spheres, they create our fund, our first experience in the US. And where will we invest? This is a question for many investors. Why should I enter this vehicle in Credicorp Capital if I can do that in large funds like JP Morgan, or which are also real estate funds? The answer is that basically, we know that all of our customers with money overseas, they have investment alternatives and create this base portfolio, core portfolio that goes to the assets with lower risks. And these are large transactions in the US. An office building in Manhattan, we could talk about 2 trillion of the asset value. We are outside that league, of that league. We won't go through those assets. That's why we're going to go through core plus or value add assets where transactions are smaller. And the invitation to our customers is heading towards the complementary portfolio here in orange that is looking for other assets that give more profitability to the portfolio by looking for 10 or 12%. And here we see that there's space you can buy and purchase in installments. There's also a matter of taxes. We offer a certain tax structure that optimizes the taxation for our customers, the IPC. These large managers say buy this in installments and you have the withholding taxes. So there's something quite complex in taxation terms, and we are having structures that are efficient in tax terms so that they invest overseas in mid-size transactions that are sometimes overlooked by these large players, but which they have a capacity of analysis and due diligence that is very professional on the part of Independencia, the GPs, and a layer of selection on the part of Credicorp Capital. That's the invitation we offer where we are going to invest in this fund. And finally, let me also add something of why to invest in real estate in the US. As I said before, and Fernando also mentioned, we are in a time of very high inflation in the US. We could even talk about hyperinflation. We've never seen this inflation here. You can see the first chart, the oil crisis in 78 or 79. That dark line is the CTI, the inflation line. And in orange, I know you cannot read this, but this is the return index, the return of properties. You have different segments here, and you can see that the annual return of properties sold in general exceeds the return of inflation in those periods. There is an interesting piece of information that almost 87% of quarters, this is always measured in quarters by the Americans, almost 87% of quarters, the index went beyond average inflation. So with this historical data, you can see certain correlation of a real estate return with inflation. This is not a perfect hedge, but it's a good way of being protected from inflation. So here we see the other periods. Of course, this resists a couple of inflationary periods. If we go to 10 years periods of 10% of annual inflation, of course, real estate business won't be able to follow that, but no other business will. So imagine the whole industry, imagine energy, construction, transportation, nobody can follow such an inflation. But there's for sure, and here we have the data of how in general this index has also performed better on an annual basis than the CPI, than inflation in the US. And if you are here, I'm getting into a period where you have an important drop in return of properties, of course, being with a team of experts from Independencia that has been for 2 cycles at least, and they've overcome the different crises. They know how to buy, what are the signals they should be aware of, and where to invest. The opportunities are there. This is the annual return index. Here is more or less the subprime crisis based on 27. You can see that by 2010, the level has recovered, and you see right now by 2013, the profitability is the one you can see here. So crises generate opportunities. And with this protection, so to speak, of inflation, we see that even though we need to be very careful and be supported by experts as Independencia, we have an opportunity to invest and get protected from inflation, maybe buying at lower prices, hoping to have a greater profitability. But this is not for free, of course. We are in an environment where risk is greater. As you can see, it's always been said that investing in real estate gives you this inflation, protection towards inflation. Let's quickly talk about the real estate in the US. I think that I said this before. We want to be experts. We are building our know-how. These are slides that we can see of large brokers and companies that conduct studies here. First chart, you can see that the office that came from levels of 10, 11%. Here you can notice the pandemic, which is really hit by teleworking. However, we have winners. You can see the industrial. The industrial in 2011 was the ugly duckling of the real estate industry. And you can see now the return goes up. And what's happened in the industrial sector is quite interesting. And even though it's interesting, of course, we are careful because here there might be a bubble or a boom, so we should be careful. Then we have more stable assets as retail and apartments. And you can see that the market today, and we'll see this in multifamily, is very healthy and with a very attractive quarter returns. This is the index that I showed before to how properties were sold industrially in the last quarter, almost 11%. And you can see all of the figures here with the apartments, similar things are happening, the most affected office and retail. So the expectations here, we have some data from RC, from Greenstead, what was expected for the NOI, the cash capacity of assets, and with all of the clouds and everything, you can see that there are opportunities. We expect an annual cash generation of around 8%, and multifamilies, whether they are houses or apartments, between 6 and 4%. So the cash flow generation capacity is okay. And when you see the price index, you see that the big winners are apartments and industrial. So we are always going to give you an idea of the concepts. So we see a very clear opportunity in multifamily where demand is has to do with demographics. The fact that the Fed has increased rates is an opportunity for the income market. This chart shows how the impact of the increase and how many households are left with no capacity to buy a household, and how many families are not able to do that. Charts say that it's around 15 million people that have no capacity to be able to buy a house when mortgage rates increase in such a level. We also see that due to the supreme crisis in 28, banks were quite wary with developers, and they're way beyond the supply, and it generates a scarcity because people need to live somewhere. And we see that young people live less people per home and they rent. And we see that there's a total deficit of supply generation in order to have the new homes that are being generated. And this gives an opportunity for rent. Here you can see the cost of paying a mortgage in the gray bar, and here the cost of the same unit comparable for renting an apartment. You can see that the gap, as it goes up, that gap also increases. So in an American person, for him, it's cheaper to rent than to pay for a household. And you should remain with the concept that despite the new crisis that we have in the US, multifamily aspect is demographic. It moves according to the demography. And if we see that, it's quite healthy. The forecast will remain stable and flat. People between 30, 39 years of age, which is the period of renting for the Americas. They leave and they rent, and it's growing. So we have a clear opportunity to invest in multifamily. We're not talking about luxurious multifamily. These are working class multifamily households in the US that have no chance to buy a home with the current rates. Let me see the time, what happens with industrial market. We need to be careful, even though it's very appealing and you have an appealing forecast. They've been unable to give the demand of square meters. The supply is behind what's being demanded. However, we need to see the commerce and what's going on. E-commerce is going up 15%, but this is going back to buying retail, and we may find some other chances. We think that there's also another opportunity. We're reaching the end of the opportunity, but there's still an opportunity. If we are able to have this, which is rent, best to suit, I have an asset which is rented for long term at a good fee, the industrial business will remain good. So we need to be careful as to making investments where you don't have long-term rents. And to give some space to Carlos, I'm going to skip the rest about the offices. We also see opportunities. You talk about offices. Yes, well, people are going back. 30% of people are still doing teleworking. Some days of the week, they are doing teleworking outside the offices, but it's gradually coming back. The market adjusted. We see some free spaces in the green line, but you can see that some of the spaces are being used again, and we need to be careful here. We have the flight to quality. these are offices that are being bought as new or renewed. We have to be careful here when the tide goes down and the best assets survive. Finally, retail market, we see that it's picking up. And so with that, I conclude my presentation. Let me just give you this concept that we do have opportunity. We're offering new product to our customers. We'll soon see some development funds from multifamily. This is a rent fund with an important manager as Independencia and always in line with the local GP with the know-how in the US. So that's it, Fernando. Now I give you back the floor so that we can move on with Carlos Blanco. Great, Francisco. This shows several things. On the one hand, the concept of being able to partner, to look for an expert and not trying to reinvent the wheel, especially in such a deep market as the American one. I think Independencia is a key ally in that regard. I think it's great. So in the institutional world as well as private banking. So this is really very interesting. I remain with this hedge concept and inflation. Of course, inflation is a global matter. As we said at the very beginning, central banks are acting, but it will be a time until this goes back to normal. Some economies will adapt more quickly than others. So I also think it's important why the US, an economy that has proven to be very dynamic. And these opportunities that Francisco explained so well, of course, you can see that inflation probably will go back. So now is an appealing time to start investing there. So probably, Francisco, there will be many questions from the audience. We are already getting some of them to have a later follow-up. To give some time to Carlos, we left him for the end, but he also will talk about a product that will complement, especially for the corporate world, for businesses, that's where the capital market has somehow closed. So we now have an open bond, that of the private debt, and he's an expert in this regard. So he can talk to you about this. Thank you, Carlos. Thank you, Fernando. Welcome you all. Thank you for being today with us. What we want to show you somehow is investment alternative that we believe is super interesting in view of the development of our countries, of course, and of course within each portfolio to incorporate an asset class that today in Latin America still has huge space for growth. I would say that this is a market or the geography where the growth space for this sort of assets is the best one, in fact. If we go to the next slide, please. What we want to show you, it basically to mention the space of private debt. And when we speak about private debt, we need to consider a broad definition, basically everything that outside of the financial system, or better, the capital markets. Something where you as an investor, you can have access to this sort of assets, and that is an access that is quite restricted nowadays. And we are, it's managers such as us that can introduce interesting investment alternatives for you. So next slide, the first information that we want to share with you somehow is how in our market, and here we're talking about the 5 main economies in Latin America, how the level of penetration is quite low. In those countries to the right of the chart, not the case of Chile, whose penetration is quite important, but the rest of the markets, you can see a huge space, and Mexico calls the attention, being such a huge market, important market, its penetration is very low in terms of the banking system. And if you see the rest of the charts, you will be able to identify that mainly the segment of large businesses is the one that takes the AUMs in the financial system. When we talk about large businesses, we need to be very careful about this definition. When you go to the definition of each market in general, you're going to find an element which is quite conservative in terms of its definition. There are several aspects, but if we follow the size, each market defines it in a different way. But in general, you see businesses that are not large corporations, even though they are included in this definition. This definition is based on very low levels. And to prove this, for instance, in Peru, just to give you some figures, this is 20 millions of soles of annual sales. That equals more or less $5 million approximately of annual sales. So in fact, we're not really talking about large businesses per se, even though this is their definition by regulatory entities and some others. And when you see the number of businesses at each of these definitions, basically you find the same thing. There is a large basis in small companies, but as you go up, there is an interesting number of companies that is at the top. Of course, with the exemption that I've just mentioned, that large business in practical terms ends up being a more rather a participation in the market, companies that end up having quite a low volume of sales. This segment of large businesses takes most of the pie of the AUM within the banking system. Next slide. And here, going to the markets where we have greater presence, you see that the opportunity is quite big. And specifically, we talk about medium and large companies here. You find that there's an important amount, I mean, the universe of businesses, when you go down and you reach that part of medium and large businesses where the main focus of private debt in general is, and I talk about that later on, you find an interesting figure, a very interesting figure or number, let's say, not only of AUMs, as I just showed you before in the previous slide, but also in the number of businesses, Peru, Colombia, Mexico, Chile. In all of the markets, we are talking about thousands of businesses at each of them. So maybe the takeaway of this slide is that the opportunity of accessing this segment of businesses is quite big. The potential is quite big. So having spoken about banks, let's talk a little bit about investment funds. Let's go to the next slide.
Here we are going to find that there is an offer of private debt funds in the region with different strategies. We are talking about some, let's say, new funds, actually, only 125. And there is a large participation in terms of the strategy, the senior direct strategy versus other strategies or special situations and a venture that is more related to entrepreneur. So we find that the lending strategy is the most interesting one. And when we see the AUMs, we see that this is not the case. The direct lending strategy is the most important one, not necessarily the most important in the region. Now, direct learning shows a strategy clearly targeted at that type of assets. And for the rest, by country type, number of funds that are being distributed in the most important markets. Chile is very interesting. And the fact of having a banking, an important banking, is a market developed in investment funds. And when we take a look at the volume of AUMs, assets under management per market, we clearly see the markets of Brazil and Mexico, and the markets of Chile, Peru, and Colombia with a lower number of AUMs, which I think in one way or other are a relevant element. And now we have the following strategy. What do we think at Credicorp Capital? Here, a brief story. The private debt is born in the 80s in Europe, based on a strategic, let's say, withdrawal or retirement of banks. So understanding the debt crisis that there were in the world, banks established a series of guidelines and restrictions to the banks, and they put a higher price on the use of capital, trying to avoid very aggressive strategies on the part of banks. Banks started to leave aside some transactions, giving way for non-banking players to participate in this business. This was in the 80s.
On the right, you can see alternative assets and private debt increasing, and today they account for, in most developed markets, even assets under management that are greater than those managed by the financial system at all of those markets. And somehow we should define public debt, private debt, he corrects himself, the debt that is not in public markets. And if we're going to see who manages the structure, mainly these are non-banking entities, the three large categories, and we're going from the less risky to the most risky: direct lending, senior debt, direct debt, mezzanine debt, which incorporates a greater risk profile, and distressed debt. These are companies in a complex and a restructuring situation of bankruptcy in some points. So where are we standing? Basically, we move within the scenario of the direct lending, basically, because that's where we see the space. And if we remember the information that I mentioned before about the financial system of our countries in the region, this is where more AUM you have, or the number of businesses is very important. Not so the case in the mezzanine or distress strategies. There are some markets, the case of Mexico, for instance, that has such funds. But when you see the deployment that is much slower, opportunities are more scarce. It takes more time to be able to identify these opportunities. On the other hand, the direct lending, the senior debt, is the funding or the need, the daily need for this sort of businesses. Next slide, please. So what do we do at Credicorp Capital, and what is our value offer in view of these companies? First, defining the segment of mid and large companies. And when we talk about mid-sized businesses, we're talking about those with sales volume. For instance, in the case of Peru and Colombia, they are close to $10–15 billion of annual sales. So we are talking about mid-sized businesses and large businesses, those below the corporations that have access to public market, to the capital market. So we basically focus on that segment where banks are present, but they are so with more standardized structures. And when I mentioned that banks are present in some markets, it calls the attention that this segment, for instance, Mexico, a very big market, as we've seen in the previous charts, but where the mid-size and mid-large businesses, there's no active participation of banks. They are there, but they are in the transactional business mostly. So in that particular market, that segment is not very much paid attention to. In a case of other markets of the region, Chile, Peru, Colombia, it's taken care of, but with more standardized structures. What do we offer? And let me now tell you why. But we offer funding through operational funds in Peru and about to operate in Colombia to these mid-sized and large size businesses segment within the local currencies. So what do we offer? Longer terms, grace periods, balloon installments, also schedules of amortization that are tailor-made to each reality. We offer flexibility. And in relation to businesses, the fact of being able to access funding within the local currency, with this type of flexibility, this gives a very important value in order to make investment decisions or reprofiling decisions, whatever you need in order to better adapt to the need that you need to refund. What are the main instruments that we have? This depends on the regulations, but mainly investment funds cannot lend. So what do? We structure private bonds. So in practical terms, this ends up being a direct loan. In the case of Colombia, for instance, or the case of Mexico, you can have direct loans, and therefore somehow the approach is mainly on this sort of assets. But our funds always leave a door open for other sorts of debts. For example, the case of Peru, it's open in such a way that you might give a syndicate of a loan, and so we can acquire such a participation. Important element when you compare this alternative with emissions or the issuance of public bonds in the markets, especially for this sort of debts, you need a third-party rating. We have no internal methodologies that allow us to identify the risk of each transaction and also put an interest rate according to that risk we are incorporating.
What are the advantages of these type of funds? Our funds do not ask the capital from day zero. What we do is have a period of investment, 3 years in Peru, 4 in Colombia. And during those investment periods, we get the capital and we find investments. Our investors are first level investors. So for 5 or 10 days, we collect the capital and we have the money to invest. And we only call them when we have the investment. Sorry, I silenced my mic. And as I was saying, let me go back for a second. We do not have a restriction in terms of the destination of the funds. We finance, we reschedule debts, and there have been some programs in our countries and in the government, and we have facilitated funding, and there's a relatively short amortization period. So restructuring the debt is something that we require now. Also, working capital, some lines use bank short lines and there was no liquidity. They took the short debt. Banks prefer to be on short. And so we can also work on this type of mechanism. We can work on CapEx, we can finance MBOs. Right now, we are just finishing a leverage buyout transaction. So what I mean is that for these type of companies that do not have this offer, broad, open, what we offer with our investment funds is this flexibility and this capacity of doing this type of funding. And we can also complement and supplement the mechanisms. And this is what we are looking for. We want to be on a part of the capital structure of the company where banks are not necessarily present. And we can supplement banks, we can join bank transactions, and with longer terms perhaps, or sharing collaterals and guarantees, get to a more complete infrastructure. And evidently, we have a dedicated team that works very fast and very effective in their response. Well, it is key to have an experienced team. When we talk about private debt, we talk about experienced people, people who were in the field, people who have a vast experience from working in various sectors, from providing the loan, collecting the loan, being able to approve a loan and place it, or investing in a private debt transaction per se, which is very complex, which requires analysis. But recovery is also more complex, ensuring that the money can be repaired timely or paid timely. That's why having a person that already experienced this business is key. And at Credicorp Capital, we have a robust team with over 125 years of experience. We have one in Peru of $125 million that was expanded to that figure. We started with a lower figure in the pandemic, and we are about to launch another fund in Colombia. This is a less developed country in private debt, but also there have been a series of regulatory modifications incentivizing this type of mechanisms in Colombia. So this is the opportunity we have with transactions that are about to start. Now in October, probably the fund will be ready with amounts that go beyond $40 million in pesos in Colombia and in soles in Peru. So it's worth mentioning that we have said structural funds, as we have a long experience of 15, 16 years operating this type of funds. We have 2 funds in liquidity, and we are giving effectiveness to these funds. And in one way or other, one fund has some established terms. The factoring is a revolving fund, let's say, and the fund has a maturity date, and they are permanently rolling and rotating so that we can have an offer for our investors. Next. Let me quickly share with you the governance of funds. It is very important to understand that at the top, Credicorp Capital is managing the whole transaction. Then we have direct lending fund. In Peru, there is a risk rater. This is how we work. In Peru, we rate the fund with Moody's, which is a local branch, and this ensures our investors the quality of not only the different aspects that we involve into the fund, but also the different practices that we follow. So then we have guideline or guiding documents. We have the investment policies that follow the best practices together with these 125 years of experience. Valuation policies, how we value these funds. These funds are valued at amortized cost, so the return is ensured over time and very low volatility. We also offer an interest rate and provide the right interest rate per risk that we run. Then we are involved in the origination of the VPs. We work on the origination with a dedicated team, and we work with our own channels. With Credicorp Capital, we are very keen on looking for those companies that really want to find these flexible mechanisms. And we also work with external channels, banks, entities that also require the involvement of other stakeholders, or boutique investment banks that are also supporting their clients in the search for new investment structures. And it is important to understand this team, this structure, because that promotes the origination, which is key. Our funds are made in such a way that investors collect very quickly. So our interests are absolutely aligned with the interests of our investors. As I said before, we have a team that participates in approving transactions, and it has two phases: the team that is looking for transactions and the team that is supporting the credit, the risks, so that when it comes to origination, we have a quality origination, and we have corporate governance, let's say, in our funds, because it has two important fronts. First, a credit committee, an internal pipeline committee of Credicorp Capital that looks to have first level quality in the transaction. But finally, the entity that approves the transaction is an independent entity. Our committees are made by members with vast experience, all of them with over 35 experience in the financial market, in the real sector. We look for a combination of both. And it is important that these investment committees have an independent majority, so the decision made will be a good check and balance for the management team. And they participate in the origination and also throughout the life cycle of the investment in the fund, making sure that at all times the investment quality is top level. And then when we structure, we get support from external teams, and we work with external offices, firms, experts, if requiring some sort of knowledge, and always taking advantage of Credicorp capital. Let's go to the next.
I just want to give you a quick snapshot far from the structure, but here we're looking for a modular structure with local teams. Even though we have a regional view of a private debt, we want local expertise and knowledge that it's fundamental in order to know how the market operates, who are the relevant players for each market, and eventually also make the right decisions. Supporting or getting the support from a team of regional credit that makes sure that these investment policies are transversal to all geographies. We are working in other geographies where we are also aiming to work in, and we get support from that regional credit to make sure that the methodology is exactly the same, that when you see a rating that we qualify as 5, we have a table of 5 ratings. A 5 should be 5 in Colombia, Peru, Mexico, and Chile eventually. So that's more or less the idea. And let's go to this slide, and I conclude here. Let me give you some key points, some takeaway messages. In facing institutional investors and investors in general, what we are looking for is to provide them an asset class that it's very difficult to find today, that it does not only contribute to risk diversification in asset allocation, and also generates an interest in profitability. As for businesses that are credit subjects, providing structural financial debt that they cannot obtain today within the traditional financial market, and this way complement the funding offer or funding supply. And in both fronts, generating as a final result economic development for our countries. I think that's fundamental when you learn how the structure of our businesses is made, and I mentioned this at the very beginning, the first few slides, there is a structure of government support for SMEs, and also larger companies might reach the capital markets directly and find this flexible funding. But when you go to that mid-size segment of mid-size and large businesses, you find that that sort of flexibility is not really present. So when you talk about the value chain of each of our economies, if you leave that mid-size, large segment aside, you might cut that development. So by providing all of this, we aim at a continuing production of that value chain. And with that, I conclude, Fernando. Thank you, Carlos. Very interesting, your presentation. And as a member of corporate finance, I had to work with you, and I really know the huge contribution that you have. In that case, that was for a company that, as we were saying, the traditional capital markets was closed for them. And thanks to this link with your fund, Carlos, we were able to have a private transaction, a private bond, and move forward with that. So this is very interesting how it complements and supports a market capital a capital market that is being quite challenged. So we'll leave a final minutes. First of all, let me thank the three speakers, huge presentations, great presentations in such an interesting subject for our development and also the reality of our regional capital markets. We have some questions. I'm going to coordinate them with the different speakers. The ESG world, Ana Maria, there are some questions about, well, in line with what you were saying, one that has to do with the advantages of having this label issuance that is not a traditional issuance. That is one of the questions. Also, we have some other specific questions, whether there are minimum amounts on label issuance, and as to understand the cost benefit, what are the costs, and also summarize the process, because in practice, taking the bond with the issuance of the label that you just shown us. Well, thank you very much. Good questions. As for the first, the advantages, we believe that, as we were saying, this is fundamental for the economy and for sustainable development that we have in the world. So we think that first, sales need to be focused on their financial strategy to have a sustainable development. Everything that we've said, continuing growing with all of the pressures that we have at an economic and political level and everything that is seen in the world, we have a duty, all of us have a duty, because it's not just investors or issuance companies. Everybody, as a consumer, we should demand that all companies comply with certain ESG criteria. So that approach, when you start developing a label issuance that helps you to see how you want to follow, I want this economic objective, how does this benefit the various groups, where my company has an impact. And I think that it also provides a lot of transparency in reputational matters. We've seen this also in terms of governance, because it also improves standards at a corporate level. So this is also very important. On the other hand, what we are also observing, and that was pointed with the other question, watching the figures that I've shown, this is not a fad. I want you to remember that this is not a fad. This is a trend, a clear trend, showing us where the world is heading due to our individual responsibility in sustainable development for our future and that of next generation. So as more investors, impact funds are following this ESG criteria in their investment strategies. In this way, we will continue to increase the demand of this sort of papers. And the idea is that that starts pushing prices so that there might be a rate differential vis-a-vis what's being issued, for instance, a bond that's not labeled. As for costs, there are some additional costs as I said there is an additional cost, and you also need to have an annual revision while the bond is in effect of this reference framework that was stipulated at the very beginning. So that's the main thing. But honestly, there's a lot of international community supporting those sort of issuance. So multilateral entities with resources in order to provide the support, both in terms of technical and financial and legal assistance to various issuance entities. And also on the part of stock exchanges, we've also have now resources in order to help with this additional cost for the labeling. And the other thing is that these costs at the very beginning might be, let's say, initial costs, and also depending on the amount of issuance, they will fade. And with time, probably investors might be able to access easily to this market windows to make the most of them. So that in relation to costs. And the other question, can you repeat that, Fernando? I did not write it down. The advantages, but Ana Maria, it was really a very full answer, and you talked about cost. It exists, it's not so relevant, and the benefits, yes, something about amounts. This is really very important for many companies. In the main bond market, there are some minimum amounts. You want a good amount so as to have all large investors and so that you can do a study of the opportunity. But honestly, we've seen many private issuances with anchor investors, with these impact funds, with multilateral entities, where there should not necessarily be a substantial amount in order to have an issuance. The other challenge of thematic bonds, as that of sustainable development, you need that mass of projects and a good amount. But with sustainable related bonds, this might disappear, the fact of a minimum amount from my project pipeline, because with this sort of bonds, you might use resources in a different way, is not in a given project, in as long as in a global sphere, you comply with the KPIs that you've set forth in the reference 2 or 3 that are relevant for the sector where the company works. And we, of course, are at your disposal. If you have any other question, of course, this is a deep well. And on the part of Credicorp Capital, we are really open and passionate about the ESG subject. And of course, we are at your disposal, both for issuance companies and investors. Thank you, Fernando. Thank you also, Ana Maria. You can see the passion that you put it at the Credicorp Capital level. This is very important. As I said at the beginning, this comes from the most senior layers of the group of the organization. So thank you, Ana Maria. We have a couple of minutes left, and it's worth tackling some doubts, some questions about private debt and real estate. Francisco, we have a very quick vision that they want in the US of the Chilean market and where you see the opportunities for the next 24 months in Chile. Quick vision. I think that we are quite entangled in the development of new buildings. The situation with the construction industry is quite complex, but we do have opportunities in specific segments like multifamilies. The demand of rent is opening the doors. And I think that the person that has an opportunity to invest in a building that is already finished, that's a goal. It's like kicking a penalty with no goalkeeper. And also the industrial sector is much easier than the residential and the offices sector. And in that case, there may also be some opportunities. That's my quick answer. And as for the North American market, we've been having very low nominal rates for many years and negative also rates. So what would be the impact in real estate assets when entering? Should we be careful about that? Yes, today we got together not long ago with Independencia to do the project pipeline, and we see an expansion of cap rate at the exit. So, and as long as you have that in the model and the enterprise is adjusted to a scenario that we'll no longer see, for example, multifamily buildings would be operated below 3% and now is closer to 5%. We need to be ready for that. There may be a period where you have a negative average because the short-term debt is quite high. And we're really happy to be partnering with people who have the experience. We need to know where we're heading in some places. Um, uh, they we have an expensive cycle of capex, and in that case, looking for assets that will generate a good cash flow, and that's key point in order to be successful. Thank you, Francisco. And to conclude, Carlos, in the private debt world, I would like to make a couple of questions. This is a world with less visibility, of course, than the traditional debt. So within your portfolio, within your fund, what is the sector, of course, within Peru and Colombia? We hope in the future will be Chile as well, in not a very far future. We see opportunities there. But what is that you consider interesting? What is the industry, and also terms, collateral structure, and thinking as an investor, expected return that you might observe in your fund in order to attack potential debtors and creditors, and also our customers, right? Sure. Well, everything that's linked to internal demand, internal consumption is moving a lot. Let me give specific examples, everything that has to do with retail or businesses that sell um, clothes, restaurants. People have gone out to the streets to consume, to buy after the pandemic. And despite the specific situations of each of the countries, this is moving quite a lot. There's a lot of opportunity in those fronts. The restaurant business has really surprised us. There have been many opportunities there. People who are investing, people who are structuring the debt they've taken in the past. Then in the manufacturing sector, we've also found some opportunities that are quite interesting. Colombia has diversified sectors, those linked to the internal ban, but also agri-exporting sectors. So the spectrum is really very broad. Even the hotel sector that's picking up, operators that are now, that have been operating before, but that have already overcome these very difficult moments of the pandemic, and they have a need of reorganizing their debt, restructuring their debt, refinance it in such a way that it adapts to more reasonable terms, always in local currency. That's what we do today. We have a way, of course, through buy products to offer the capacity and take something in foreign currency, but our strength is in the local currency. In terms of structure, what we are looking for, the ideal thing would be, and this is not always feasible, it depends on each sector, but we're looking for a combination of actual assets and real estate, and flows, of course, depending on the sector. And I go back to the example of the restaurants in that case, or the retail business. In general, you don't have real estate assets because it's not part of the business. They rent the property, and those assets do not exist. Flows are really important. The credit card flows, in some cases, also flows of remittances that you might capture, always with trust funds. These were the examples because even though the combination, the exact combination, or the ideal thing would be this thing that I mentioned before, it's not always feasible due to the specificities of each sector, but we're looking for a structure that will ensure that the risk is being understood and managed properly. In terms of returns, what we offer in general is an alternative that's above that offered by the market. In the current situation, after we have something, for instance, in a current scenario where rates have gone up, and of course, we turn around to see what's going on in the traditional financial sector, where the greatest supply of this sort of private debt generally comes from for the segment we are aiming at. We always are looking to be a little bit above them. And when you see the public markets, and in facing investors, you see some interesting offer in terms of what the screen offers. But when you go look for those papers, of course, they were left in the screen. They're not necessarily there. Issuers are not going to the public market, so the private market ends up being a very good option with quite a reasonable rate. I mentioned a while ago about internal pricing methodologies. We're going to see the market how it is. We always set a price of a spread over the sovereign, understanding the risk profile of each transaction and some additional factor due to the liquidity of the transaction or the type of paper. And this is how we set prices, making sure that each transaction has a market price. Peru, due to its customs and habits, fixed rates. In Colombia, it linked to an index. So these are all specificities of each sector and market, but they end up being interesting investment in view of portfolio diversification within for our investors. Very full answer. Thank you, Carlos. So to conclude, I think that we've given an example as Credicorp Capital of Innovation and the way in which we are addressing all of the things that are being presented by regional markets, capital markets, something very strategic of such as ESG and how to put it within our market. We talked about bonds, but it could also be loans with Ana Maria. Francisco gave specific opportunities of diversification, investing in real estate funds in the US, and Carlos gave us a crucial aspect in this world that will complement the cash supply that maybe the traditional banking won't be able to reach there, but this fund, the one that is being structured by Carlos in Peru and also in Colombia, will continue to grow, will probably materialize this or complement this supply to our customers. We are innovative, even though the traditional markets have been reduced. The non-traditional ones continue to be there, and we're there supporting our investors and non-investors and everybody who's in need. So thank you very much. With that, I greet you all. Thank you so much to the three of you for your great presentations. I hope the audience really liked this panel as well. Thank you. Thank you. Bye-bye. Bye. Thank you.